If you're in or approaching retirement, then pensions are likely going to be one of your main sources of income when you leave work. How you draw on your pension is really important to make sure your pot lasts as long as possible and where you can reduce any taxes. As a financial planner, I see a number of common missed opportunities when it comes to pensions, especially around how to make best use of them for the tax relief on the way in and how to best plan withdrawals on the way out. In this video, I'm going to cover 3 pension mistakes I see all the time and how these simple changes can save you a hefty chunk when it comes to tax. In the video, I'll be using an example which shows how these mistakes can impact wealth by thousands of pounds. The case study can apply to pensions of all sizes and those who have various levels of income. So look out for how these missed opportunities can apply to your own situation. To highlight these mistakes, I'm going to use recent clients of mine, but for the video, I have changed their names. So for today, we have Phil and Sandra. They're both 57 and they plan on retiring in 2 years' time. Phil and Sandra have worked out their expenses and they estimate they need £45,000 worth of income after tax each year. To fund their retirement, they have different pots they can draw from. They each have a pension worth £250,000 and they also each have ISAs worth £150,000. For the last few years, Phil has been focused on building up his wealth to prepare for retirement and has been contributing regularly to his ISA. However, as Phil is approaching retirement and still working, it provides a great opportunity to make use of the tax relief pensions have to offer. If Phil contributes to his pension, any contributions he makes, he will receive tax relief at his marginal rate. I proposed the idea to Phil to use his ISA to further fund his pension. Here was the initial plan. If Phil contributes £40,000 to his pension, which he funds from his ISA, HMRC topped this up by £10,000. In addition to this, Phil can also claim back a further £9,946 from HMRC as he earns £100,000 and therefore is a higher rate taxpayer. This is an effective cost to Phil of £30,054. If Phil does this for the 2 years before retiring, this means there's an additional £39,892 in his combined ISA and pension pot. The tax relief you receive from a pension makes it one of the best tools for building wealth. However, many people I speak to are put off from pensions as they can't access their money until they're 55. However, once you turn 55, or even as you're approaching it, this accessibility issue is less relevant. Where you have savings or disposable income, taking advantage of pensions can make a significant difference in boosting your overall wealth and therefore funding your retirement. Now, you might be thinking, well, yeah, that's great. I get tax relief on the way in, but I have to pay tax when I withdraw from a pension, whereas with my ISA, I don't. So surely the tax works out the same anyway, and really, I'm no better off. Here is where I often see mistake number 2. The second pitfall is misunderstanding the relationship between the tax relief of a pension contribution on the way in and what the effective tax rate will be on the way out, and how planning for this can ensure you take advantage of it. Let's look at this for Phil and Sandra. They were planning on using their ISAs to fund the first few years of retirement. However, we need to consider their current and future income tax liability when deciding how to best draw their income. At the start of retirement, Phil and Sandra will have no sources of taxable income as they won't be state pension age. So if they're not earning any income, how can we make the withdrawals as efficient as possible to ensure they're using any available allowances? To start, Phil and Sandra both have their tax-free personal allowance, which is currently £12,570. And with their pensions, 25% can be withdrawn tax-free and the remaining 75% is taxable. So knowing these two rules means we can take advantage of them together to best fund their income. If we withdraw £16,760 from Phil's pension, where we combine both the taxable and the tax-free elements, he will pay no income tax. This is because 75% of the withdrawal is £12,570, which makes use of his personal allowance. And if we do the same for Sandra with her pension, this combined gives a total income of £33,520. To make up the additional income to meet their £45,000 need, we can make a further withdrawal from Phil's pension of £13,506, which gives a net amount of £11,480. Therefore, in total, Phil is only paying £2,025 in income tax to receive an income of £28,240. This is a net tax rate of 7.2%. And when we look at Phil and Sandra's tax liability combined, their joint net tax rate is only 4.5%. Also, Phil and Sandra haven't touched their ISAs, which they can use later on if they need to make any larger one-off withdrawals. So when we compare Phil's tax relief on the way in, being 40%, and on the way out it is 7.2%, this is a net difference of 32.8%. This strategy not only works for high rate taxpayers, but for basic rate taxpayers as well. Planning prior to retirement is really important, as we can take a long-term view of how we'll fund our income and therefore work backwards to help us minimise any current or future tax liabilities. By knowing Phil and Sandra's expenses in retirement and when their state pensions start means we can best use their pensions and ISAs as effectively as possible. The final missed opportunity I often see is a smaller one, but still worth knowing, and it is not realising that you can continue to contribute to a pension post-retirement. If you're not working and under 75, then you can contribute £2,880 each year, and HMRC will automatically add £720 in tax relief, giving you £3,600 a year. In the case of Phil and Sandra, we're planning on using their personal tax-free allowance by withdrawing from their pensions, as we saw in our second point. However, remember, 25% of your pension is tax-free, so even if they withdraw their £3,600 straight away, they'd receive 25% tax-free and pay 20% on the remainder, which gives an effective tax rate of 15%, which is a net withdrawal of £3,060. So for a simple movement of money, which may take you a few minutes a couple times a year, where you put in £2,880 into a pension, you can take out £3,060. It is well worth it. I mapped out Phil and Sandra's financial plan before and after the above three changes to see what impact this had on their total wealth. For these plans, I've used the same growth assumptions, same levels of income and same starting values. The only differences between them are where they've made their contributions, where they have withdrawn their income from, whether that be their ISAs, taxable or tax-free part of their pension, and when they've made these withdrawals. Here shows a plan before we made the above changes. At age 59, the total savings pot is just over £886,000. And at age 99, the plan forecasts their savings to be just over £147,000. However, with the changes, the total savings at age 59 is over £927,000, and at age 99, £320,000. This is a difference of over £40,000 at the start of retirement and £173,000 at the end of the forecast. The point of this video is to show you how simple changes in your tax planning can have a huge impact, which could mean you can leave work earlier or spend more of your money in retirement. The taxes used may or may not work for you, as effective tax planning will depend on your situation, such as your current income, your expenses now and in retirement, your asset levels, and whether you have any future income sources such as a defined benefit pension. So if you're thinking of using some of these strategies I talked about earlier, make sure you evaluate them against your own situation and context to see if they work for you. With this in mind, this type of forward-looking planning must be done on a continual basis. Monthly expenses are likely to change in retirement, and perhaps as you get older, you will spend less. Also, we can factor in inflation, but as we've seen recently, this can be a lot higher than we all expect, and therefore to maintain income in real terms, we need to be able to withdraw a higher amount. Tax bans, allowances, regulation no doubt will also change, and we don't know what unexpected events may happen to us in the future. Therefore, having a buffer and flexibility in the plan is key. What's also important is knowing whether you have enough in your pensions and savings to be able to retire in the first place, which is why you should check out this video here where I use a case study that shows the key factors you need to think about to ensure you don't run out of money in retirement. I'll see you over there.